what is this thing that we're calling the global financial crisis? The first piece is to think about the real effects of it. What did it coincide with when we're talking about the real economy? And that is the United States GDP, starting with the US. We'll have another slide on what happened in Europe. The US GDP, the largest drop since the Great Depression. And 6 years since the crisis began, growth is still anemic. So here's a picture, right? And there's not a lot in this picture, it's sort of a straight line with a dip in it, but I'll explain why that dip is an important one. So this goes back to 1980. We could make it go back even further, but then it's even harder to see some of the dips. You can see nice, calm growth, looks relatively steady. We get this nice drop that's starting at the end of 2007 when the recession officially started. And that drops very significantly compared to anything that you see here in the history back to 1980. And the really important thing to me in this picture is we are not yet growing back at what the trend line would have been before the recession. Okay? It's almost a statement of religious belief among macroeconomic forecasters that all recessions are temporary ones. And if you look at a picture going back to before the Great Depression, to the best of our ability to do it, and just fit a line through it, that line just fits perfectly going back even before the Great Depression. So the Great Depression really looks like a big, huge depression, but then it comes back right around the time of World War II into the fact that you're actually up to the point that it looks like GDP has grown at 2.7% kind of forever. That has not happened here yet. So we have not, if you want to kind of just forecast this line straight out, ask whether or not we're going to get back to it. If we don't get back to it, that's a very big gap. If you think about the lost output, it's integrating the difference between the line that we would be at and the line that we're actually on forever. And there are very large debates about whether or not financial crises that are associated with recession. So if you have a recession and a financial crisis at the same time, does that create a permanent effect, permanent negative effect on output? And that debate is more than just an academic one. People have to decide, whenever we read estimates of what the federal deficit is going to be, or the overall budget, the overall federal debt will be 10 years from now. In there is some forecast of what's happened to growth over the next 10 years. So you have to really think about, are we going to end up back up there or not? And so far we haven't. Right? First time in history, including the Great Depression, and measured history in the United States. The second thing is going along with output, or GDP, is employment. And we have a very significant underemployment problem in the United States, which is getting a bit better but still is not totally cured. This is the unemployment rate, which is one way to measure it, but perhaps not the best way to measure it. So this is the fraction of all people who are working, or the fraction of the labor force, which is everyone who is working or looking for work, that doesn't currently have a job. And that peaked very close to 10% in this recession, which by historical standards you have to go back to the Great Depression in order to find something bigger than that. You can see why they call this one great. Right? We didn't have fantastic data then, but we know a lot of people weren't working. So we hit those levels, the same level that we hit in what was a fairly severe recession in the early 1980s. And we've only gradually been coming back. Another problem here, and one that these numbers don't do justice to, is that not only do we have a lot of unemployment, we have a fair amount of underemployment. So by most measures, there are a lot of people who are working part-time jobs, more people than you would see historically, working part-time jobs who would prefer to have full-time jobs. They're not counted as unemployed. Or people who have left the labor force, so they're not in the numerator or the denominator of the unemployment rate because they were discouraged. So the employment rate, which is just take employment and put it over the entire working age population, that is at a lower point than any time in recent history. So when we look at both employment and GDP, we really see a very significant economic crisis. I haven't talked about what makes it financial yet, but it seems that whatever went along with this or may have caused this, if it had financial causes, there's pretty good important reasons for us to understand why. So you can't have not read the newspaper. If you've read the newspaper, you know that housing prices went nuts prior to this crisis and then during it. It's good to see a picture if you haven't seen a picture. This comes from Bob, one of many millions of pictures Bob Schiller has that look pretty much the same, that are really scary. The impressive thing about Bob Schiller is that when this line had not yet started going down, he was yelling and screaming, telling everybody, it's going to go down. It's going to be bad. Okay, so if you look, this was the housing bubble of my youth, right, where people lamented, I can't believe I bought a house in 1989 in Massachusetts. You know, all of my friends, I graduated in 1989. Everybody was very disappointed if they purchased any real estate. This was supposed to be bad. This is nothing. In fact, we have little, what we call a dead cat bounce here that's just as big after our housing crisis just ended. Okay, that looks as bad as the bubble did back in 1990. So this just went way off the charts. And what's interesting, the index value, you see on the left here, this is not a typo. That says 1890 equals 100. That's not 1980 equals 100. That's 1890 equals 100. By 1980, it's only at 117. So the real housing price index had hardly budged over the first 90 years that we're keeping track of it. Okay? And then in that whole amount of time, as we get to 1997, it's about 8% higher than it was more than 100 years before that. And then it basically almost doubles before we get to the top of the bubble. So this is really quite striking. And as I'm going to repeat many times today and over the course of the semester, it turns out that housing bubbles have been coincident with financial crises in every major financial crisis since World War II. So it was not without reason that Bob Schiller was saying in 2006 and 2005, you know, when this bursts, and it will, it's going to be bad. Okay, because this is what all the other financial crises look like. As we'll also see, just sort of a hint to what's to come ahead, it's no accident that it's housing that tends to be, in a modern financial economy, the thing that ends up in a bubble before a financial crisis, and not some other asset class like the stock market. Okay, the stock market was not in a bubble before. It did not have a big crash, and it has not, in many other countries, had a big crash around the time of their financial crises. Okay, another thing that certainly has received a lot of press that's related to housing, and that today I'm just going to be presenting as a fact and maybe something of a puzzle, is this notion of subprime housing debt. So what was going on in our previous picture, this is just housing prices overall. So everybody's houses were going up in value in general, in some places much more than in others. But then there's this other issue about subprime housing. So what does that mean? When you buy a house, you get a mortgage. Go to the bank, you give them your credit history, you show them you have a job, you hope, you have some money for a down payment. And one of the things that you're showing them is your credit rating, which brings all those things in. And below a certain credit rating, you are not considered a prime candidate for a mortgage. So you don't necessarily qualify under various programs that require you to be prime. And for a very long time, it basically, the mortgage market for non-prime borrowers didn't work, right? And you can see why it wouldn't work. You would say, well, I can loan to you at 6%, but if somebody's a bigger risk, yes, you have the collateral of the house, but I like having not just the collateral of the house, but the likelihood that you'll pay me back, because I'm worried about the world where housing prices fall and you can't pay me back at the same time. So I should charge you, instead of 6% or 7%, 9% or 10%. But it turns out that if you charge anyone 9% or 10%, they can't afford to pay you back. So there's really no way to give mortgages to people who would have, under a normal risk-based formula, simply had to pay a higher rate. The effective innovation, and we'll call it that, in subprime lending was to recognize that there was some asset that was owned by buyers who had low credit ratings that wasn't being properly monetized in the mortgage process. So specifically, that is, when you buy a house, what you're getting is all the upside on that house. Okay? So if I buy the house and the house appreciates tremendously in value, I get all of that upside. Well, if I can't afford the house in the first place, I don't care about that. Wouldn't it be nice if I could sell half of that upside back to the bank at the time they write me the mortgage and get them to write me an affordable mortgage? So the original designs of subprime housing were effectively just that. They were giving away some of the upside of the house back to the bank. Now you might wonder, why have I not read about contracts like that? Those contracts were simply the contracts that were adjustable rate mortgages that adjust a lot after a couple years unless you refinance them. Otherwise you pay a penalty, right? You can only afford to pay that penalty if your house is appreciated greatly in value. And so you do that, you take that money out of the house, you refinance, and you hand that over to the old lender, and now all of a sudden you were able to get the mortgage in the first place because you were able to sell some of the potential appreciation on the house. That's what it was viewed at the time, sort of a piece of financial innovation. And when we do housing later in the semester, I'll go through that in more detail. But once they figured out how to do that and how they could then package those things and sell them to other people, we see something of an explosion. So starting in 2001, this is in billions of dollars on the left-hand axis. So there was some subprime stuff that was going on always historically, and some of it was being securitized. We'll talk about securitization next week. Some of it was being securitized, but it's not until 2002 that it really starts taking off. Over the period 2001 to 2006, somewhere between $2 and $2.5 trillion of subprime mortgages were sold, of which a little bit more than half of them were securitized. That sounds like a lot of money, but relative to the stock market, the stock market falls by 15%. That's the entire amount of subprime that we did. Okay, so so a puzzle about the financial crisis to some extent, the financial side of the crisis is, if we really think this was caused by subprime mortgages ending up being worth a whole lot less than we thought they were, we have to explain why something that started as being worth about $2.5 trillion, even if its value was cut in half, that's actually not that big of a move in the stock market. So the total wealth shock isn't really that huge in terms of how much it's hitting financial markets. So that will be a theme that we'll go through over the course of the semester. So how could something that's big, but not so unbelievably big relative to the size of our financial system? I mean, $2.5 trillion is how much assets JP Morgan has, first approximation. Okay, so it's one big, huge bank. Why would that come close to taking down the entire system? Okay, finally, our last piece, which I don't have a picture for, is just the general sense of what happened to the financial system and how much it was restructured over this time. We see that going into the financial crisis, we had, or let's say in early 2008, 5 major investment banks in the United States that were called investment banks and were regulated by the SEC. There was Goldman Sachs, Morgan Stanley, Lehman Brothers, Bear Stearns, and one other Rick Perry one that I can't remember. Okay. So we basically had 5, Merrill Lynch. So we had 5 that were going into the financial crisis, and basically by the time we get through just the first couple weeks after Lehman is gone, we have 0. Okay. Bear Stearns went away in March of 2008. Lehman Brothers goes bankrupt in September. Merrill Lynch bought by Bank of America, and Goldman Sachs and Morgan Stanley say, we're not investment banks anymore, now we're banks. Okay. And they went and got themselves bank charters and became bank holding companies. This was really a big deal. So a picture that I wanted to show today, but realized it would take me too long to explain what all the different things were on the different axes, and people would think I was out in left field. But it's an incredibly scary picture, is just effectively something that's the spread between secured and unsecured bank lending. And that spread, either a bank is showing you collateral or not, that spread's usually like 10 basis points, or 1/10%. And in the crisis, it just absolutely blew up to 5-6% in the worst part of the crisis. It was, I think, really just incredibly scary. So if people here were working on Wall Street at the time, probably saw that up close. A lot of you are too young to remember that, so you were in school and maybe you heard something was going on, but it was tremendously scary. Really, really educated, smart people who knew a lot about markets were saying, I'm going to get a lot of guns and bury my gold. And they were serious. Right? So for a little while, we thought there was a decent chance that the financial world was going to come crashing down. So that's kind of, at that point in time, I remember I was teaching here at the time, and I was teaching a class on venture capital, which is all, balloons and champagne. And I'm teaching that class, and then this thing starts to happen, and I was teaching Tuesdays and Thursdays, and after the AIG thing happened on on Thursday, I said, all right, I'm canceling class today. We're just going to talk about the financial crisis. And one thing I told my students that day is, I said, you have to understand, this is September 2008, this thing will eventually go away, we hope. You guys will get on with your lives. My life is forever changed. My entire profession is forever changed because we didn't see this coming. And we're going to be figuring this out and studying this forever. And that was the only forecast I made in that entire time that was right. Everything else I said was wrong, but it has totally changed everything that we're studying and everything that we're working on. Now, what makes this crisis global, the course is called Global Financial Crisis, so not just the financial crisis, and I'm going to try not to be too provincial in focusing on the US for everything that we do. The European part of this global financial crisis, in many ways, is significantly scarier than what happened in the United States, and it is ongoing. Okay? And in part, what keeps this from being a pure class in economic history is the fact that the Euro crisis persists and remains the problem. And let's just look at a couple pictures first, and then I'll talk more about that. So first, this is real gross domestic product. And just doing it in a bunch of countries. So Germany and France, that are the two largest, most important economies in the Eurozone, but also some other big ones that are important too, Italy, Spain, Greece, and Portugal. And I haven't even put Cyprus up here. That wouldn't even show up on the picture. They're really in bad shape. So we're going to start in 1999 when they're at 100. Now, if you look here today, other than France and Germany, all of the others are not that much above where they were in 1999. So we're 14 years later, and they're maybe about 5% higher. Okay, so this is almost a lost decade already. The scary thing is, it's not done. Okay? It's not just the economics. So here's the unemployment rate. Now, Europe always has somewhat higher structural unemployment rates reported than you see in the United States for what would appear to be just the same good economies, for which there's a variety of theories for why that's the case. So we do have to adjust. I mean, even back when things were relatively healthy, they're more likely to be hovering on average in the Eurozone more around 7 or 8, 9%. But today, okay, in some countries we're all right. Now look up at Greece, Spain. These are riots in the streets kinds of numbers. Right? They're really scary. And the youth unemployment numbers are even higher. A fundamental problem that Europe has right now, and I promise more detail on this later, is they have one currency, right? We know that, or the euro area has one currency. And you might wonder, what's the big deal about having one currency? We have one currency in the United States, right? So what's the big deal? And the big deal is in the United States, when we get a bad shock in Massachusetts, but there's still jobs in Texas, people can move from Massachusetts to Texas relatively easily. Okay. One of my friends is about to move to Texas from the Northeast, so it's not that hard. So it can be done. They speak the same language. It's largely the same, broadly the same culture, the same laws, the same licensure for a lot of different things. Also, if Massachusetts is having problems, there's automatic money that flows to Massachusetts basically from Texas taxpayers through our fiscal system. We don't have that in Europe right now. It is hard, and it remains hard to move from Spain to Germany, not for legal reasons, but for linguistic and cultural reasons. And it's hard to get a job in Germany if you're a Spanish professional. It's much more difficult than moving from, say, Texas to Massachusetts or back. Also, they don't have any form of fiscal federalism. They still don't have it. And the bet they made when they went to the euro in 1992 was effectively that before there would be a major shock that they wouldn't have any monetary flexibility to adjust to, they would have succeeded in getting this federalism working. It was a gamble, and a lot of people at the time understood that it was that gamble. But that gamble turned out to hit them hard. And so we still have a case where many of the countries in the South and the periphery of Europe, after the shock of the financial crisis, are not competitive with Germany and France. And that structural problem can't really go away unless real wages fall in those countries. Real wages can't fall in those countries from a currency reason. They actually have to have deflation. And deflation is a very, very tough thing, and I promise we'll talk more about it. It's a very tough thing when you have a lot of people who owe money, because the money you owe is nominal, and that doesn't fall, but your wages fall. So it creates a drag on a country's economy that can last for a very long time. Japan has had this problem for now 20 years, and it could be the case that Europe is looking at another 10 years before they can drag out of it. So it's not just what's going on in the US. In part, Europe did not take an enormous amount of medicine in 2008. And so instead of taking a whole lot of medicine in 2008, this problem has continued to drag on.